The S&P 500 and the Nasdaq both on pace for their worst weeks since last September. Joining us right now is Marta Norton, Chief Investment Strategist in Power Investments. What do you do right now? We've seen a sort of a very, I don't want to say strange movement, but we've seen a movement that I don't think people were necessarily prepared for. And the question is this a falling knife? Is everything on sale? What do you do?
Well, you know, it's interesting because there are so many moving variables, as I know you all know. There's the tariff question. There's questions around consumer sentiment. There are questions around how sticky inflation is, even absent tariffs. So there's a lot of different headwinds to process. One thing I would point to is that, largely speaking, when we're looking at the fundamentals, and let's talk about earnings, for example, we're wrapping up Q4 earnings season, those have actually been really strong. And expectations over the course of 2025 is for earnings to remain strong. And so that's one engine that we can point to that seems relatively positive in this environment. The problem is that valuations, even after the volatility that we've seen recently, are relatively high. So that's kind of moving against the market. And then when you take in something like tariffs, which the market has, at least until this point, largely categorized as negotiation tactics, but could very well be broad-based and long-lasting, considering some of President Trump's comments, that's something that really could, at least on the margin, pull those earnings back. So at least as we're looking at it in 2025, I think this is a year for more moderate results relative to what we've seen in prior years, and certainly a lot of volatility.
Is there something that you would not touch right now?
Well, you know, if we're looking purely at a valuation standpoint and we're looking at all the different sectors and where they sit from a price perspective, there are a few areas that seem particularly pricey. Technology is one of them. So if we're looking at it on a price to expected earnings basis and we're looking at kind of a time series and where do today's estimates sit relative to prior years, we're really in the most expensive decile, even after the sell-off. Financials are in that same area. Utilities also. So a lot of good news has been baked into those areas. I wouldn't say I wouldn't touch them, but I would look at them with a little bit more skepticism in the sense that it's going to be hard to drive their prices forward. A lot of good news baked in already there. We're calling this year a year for balance over conviction, really arguing that it's better to kind of spread those bets out rather than focus in on particular areas. It just doesn't seem like there's a ton of screaming opportunities.
Well, if there's no screaming opportunities, is there any argument to be in cash, at least partially? I mean, would you actually take money off the table?
It's an interesting question because, of course, the conventional wisdom right now is that yields, you know, cash yields are coming down and that the cash bonanza is behind us. I think there's an argument to make to still have some exposure to cash. The value of cash, of course, is that it gives you that dry powder so that you can move in if there are periods of volatility. And I think that gives it some utility in this environment. From a duration standpoint, of course, we saw, you know, yields move higher, particularly out the longer end of the curve. And that offered a bit of a buying opportunity, but those are coming down. They're still much better than they used to be. So I guess you could argue that, broadly speaking, bonds have utility that they haven't had for a few years, especially if growth scares remain something that's front of mind for investors.